Hello, viewers, and welcome to this week's edition of the Weekly Macro Roundup, where we touch on the leading macroeconomic and financial market events. Let's jump right into it.
In the U.S. economy, SpaceX just made history, officially joining the NASDAQ, and retail investors piled in with over $100 billion in subscriptions. Consumer sentiment ticked up as gas prices eased, but the backdrop is mixed. Household net worth barely grew, stocks slipped, and the savings rate fell to 2.6%, a four-year low. Inflation is heating up again. CPI jumped to 4.2%, the fastest in 3 years, raising the odds of another Fed hike. And the Treasury is issuing more than $500 billion in T-bills each week. Manageable for now, but risky if borrowing costs rise. Washington refunded $22 billion in illegal tariff collections, even as courts allowed the new 10% worldwide tariff to stay in place during legal challenges. Regulators are tightening oversight of AI in banking. Small business optimism has fallen to its lowest since 2024, but housing is showing life. Existing home sales hit their fastest pace of the year. Globally, the Iran and Ukraine wars continue to distort energy markets. PPI surged 1.1%. Refiners are shipping more fuel to Africa, and the World Bank cut its 2026 global growth forecast to 2.5%. Diplomatically, the U.S. and Iran are edging toward an interim deal to reopen the Strait of Hormuz, with an 80 to 85% chance of agreement, a move that could shake OPEC's fragile grip on oil prices. Markets are responding. U.S. equity funds saw their biggest inflows in 3 weeks as tech earnings kept the AI rally alive, and the trade deficit narrowed on stronger oil exports.
China's trade tensions with Europe just intensified. EU imports fell for the first time in 3 months, while China's surplus stayed above $30 billion, keeping pressure on Brussels. Beijing is tapping strategic reserves to offset lost Gulf supplies, helping cool crude prices, even as the IEA calls the Iran conflict the biggest oil shock on record. Exports, meanwhile, are booming. Demand for chips, autos, and high-tech goods surged in May, powered by the global AI wave. But at home, the picture is mixed. Banks are canceling events amid a crackdown on cross-border investment, and regulators are warning companies to protect labor rights as AI adoption accelerates. Inflation is split. Consumer prices stalled, but factory-gate inflation hit a 4-year high as energy costs spike and weak demand blocks firms from raising prices. Foreign companies remain cautious, even as China plans a massive 2 trillion yuan AI infrastructure push led by state giants. Markets are adjusting too. Bank of America has exited its long China bond position, and Nomura doesn't expect rate cuts until 2027. In the Eurozone, Germany's recovery is slowing. The Bundesbank cut its outlook as the Iran war drags on, though fiscal stimulus should lift growth from 2026 onward. The ECB is turning hawkish again, signaling another rate hike after raising interest rates for the first time in nearly 3 years. Inflation is spreading beyond energy, and Europe's budget watchdog is criticizing governments for bending rules on energy aid. Across the continent, leaders say Europe must toughen up. The IMF warns fragmentation is holding the bloc back, while the US and China surge ahead. Without reforms, Europe's productivity gap could widen sharply by 2050. Germany is feeling the strain, but avoiding recession thanks to heavy defense and infrastructure spending. And there's a small bright spot. Manufacturing output rose in April for the first time since the Iran-Iraq war began. Chancellor Merz is pushing for tougher trade measures against China and promising domestic reforms as Europe debates how to protect its economic future. Canada's trade minister says the US-Canada relationship is shifting, with new bilateral deals expected alongside the upcoming review of the North American Trade Pact. But President Donald Trump says he won't renew the current agreement, setting up a long stretch of negotiations and annual rolling reviews. The Bank of Canada held rates at 2.25%, warning that weak growth and rising inflation are pulling policy in opposite directions. Meanwhile, oil pushed Canadian exports to a record high in April,
widening the trade surplus to $2.7 billion, the biggest since early 2025. Ottawa is also investing over $1 billion to boost competition among grocers and fight food inflation. On markets, the loonie briefly hit its weakest level of the year as oil prices slipped below $90 a barrel. The Bank of England is set to hold rates at 3.75% on June 18, with economists unsure what comes next. Inflation is expected to peak near 3.6% later this year, before slowly easing through 2027. The UK Treasury is resisting calls to speed up defense spending, even as geopolitical risks rise. And a decade after Brexit, new analysis suggests the UK economy may be 2% to 4% smaller than it would have been, a long-run hit worth around £30 billion in lost annual tax revenue. Chancellor Rachel Reeves says she'll ease the tax burden on wealthy US investors relocating to Britain, addressing complex double taxation rules tied to US LLCs. Public sentiment is shifting too. On Brexit's 10th anniversary, support for rebuilding a closer relationship with the EU is at its highest yet. But political infighting at home and strict EU red lines make any compromise extremely difficult. Retailers are sounding the alarm as a surge of cheap parcels from China undercuts UK businesses. And Prime Minister Starmer faces limited options to fund his agenda without breaking tax promises. And in housing, RICS reports property professionals turned more pessimistic in May, with expectations for short-term prices weakening again.
And that's a wrap for this week. I hope you enjoyed it. If you did, please like, share, and subscribe. If you did not, please leave a comment on how to improve this content. Cheers, and see you next week.